Good day viewers, today we are in conversation with Dr. Joseph Thomas, Head of Research, Emkay Wealth. Welcome Dr. Joseph. What is the context and environment against which the budgetary exercise is being carried out this time? Is it very different this time compared to previous years?
Yeah, it is slightly different this time. Last 2 years we were in the grip of the pandemic. There was a tremendous amount of fiscal expansion.
Right.
And we had soft money policy all over the world, in India too. This time around the conditions are slightly different because of normalization of liquidity and the hard money policy followed by the central banks. There is a likelihood of at least a mild form of recession or a slowdown, economic slowdown happening in some of the major economies of the world. So the context against the background against which the budget is being prepared and presented is slightly different. It has its own challenges also. During the pandemic, the fiscal expansion helped hold the economy quite well. And as of today, the challenge is to stabilize the growth and to ensure that economic activity goes on at a normal level.
Okay.
That's the main challenge the budget would face.
Okay. On the global macro front, how do you visualize the performance of major economies? Do you expect the resilience of the Indian economy to hold well?
Yep. As far as larger economies are concerned, like the US, China, and the economies of Europe, as I have just mentioned, it's highly likely that there will be an economic slowdown.
Okay.
This economic slowdown is actually the result of the tight money policy, higher interest rates, and also some amount of demand destruction due to the very high inflation.
Okay.
Therefore, in all the major economies, it is most likely that there will be economic slowdown.
Okay.
The US, the Europe, as well as China will display much lower rate of economic growth
Okay.
till the end of 2023. Beyond 2023, there could be gradual economic revival.
Okay.
There are some economists and analysts who expect a very strong recession. Some of them do expect a very strong recession. But in our view, it's most likely it's going to be a touch and go slowdown in economic activity.
How do you look at the fiscal deficit glide path and the need for government to spur private capex?
Yeah, the fiscal deficit issue has been there since the beginning of the pandemic because there was need to expand government spending to support the economy. The fiscal deficit is expected to come down to around 6.4%
Okay.
in the current financial year from 6.8% which was there in the last financial year. It is expected that government will be able to meet that fiscal deficit target of 6.40%. For 2025-2026, the fiscal deficit target is 4.5%, which was set in the last budget. We should be looking forward to the fresh fiscal deficit glide path, which the finance ministry is going to chart out in the current budget to see how we are going to move towards a much lower fiscal deficit. It is achievable. One of the factors which would help the government achieve the fiscal deficit targets is that the economy is expanding. Therefore, naturally, the GDP would also expand. And therefore, as a percentage of the GDP, the fiscal deficit is more likely to come down. So that's a factor which will support the attainment of fiscal deficit targets.
Okay.
Second, the tax collections, the tax revenues have been quite buoyant. Though they have not been extraordinarily high, they have been quite buoyant. And we feel that the tax buoyancy, if we can retain our rate of economic growth at around 6.5% GDP growth, with some amount of tax buoyancy, we'll be able to attain the fiscal deficit targets very well.
Okay. Okay. The government has been active on the rupee bilateral trade. How is this going to impact rupee in relation to global currencies?
Yeah, the rupee trade with some of the economies may not be of much impact as far as the dollar rupee exchange rate is concerned, or as far as the any other major currency exchange rate is concerned. Say, for example, the rupee against the euro, or the rupee against the yen, or the pound sterling. That is because our trade is very small compared to the global trade.
Right.
And it is this very small trade that we are trying to manage through the rupee trade. And it may have very limited level of acceptability. But it's a very good step in the right direction. Also, as far as rupee is concerned, the rupee would stay weak, and it could even become weaker, mainly because of one factor, that we import more and we export much less.
Right.
Therefore, the strength in the rupee is often the result of very good inflows from FIIs and FDIs.
Right.
So if we can retain the inflows or attract more inflows, that could help the rupee become stronger.
Okay.
But it is less likely that we might see it in the immediate term. Therefore, the rupee trade with some select countries at this point of time may have only a very limited impact as far as dollar rupee exchange rate is concerned.
Okay.
Dollar rupee exchange rate will navigate the rest of the year and for many years to come based on the economic fundamentals. That's trade and investments and how they move.
Okay. Sure. Thank you. Global energy prices have been high and it is responsible for the inflationary condition. Do you see any action on this in this budget, especially on the alternate energy sources?
Yeah, there will be some measures. In the last few years, we have seen some measures always being announced to promote, say, solar energy.
Right.
But for solar energy to become a fad among the people and for people to utilize it in a major way, it will take much more time. Therefore, we expect that there could be some proposals. There are already a lot of discounts and concessions which are being granted for setting up solar units and solar panels and all that. So there could be some provision for that in the budget. It's highly likely because it's an alternate energy source.
Right.
In the last 10 years, the world has shifted to alternate energy sources to the tune of about 10 to 15% of its energy requirements.
Right.
Which means that if we were using 100 units of oil,
Okay.
probably we'll be using only 85 units of oil now.
Okay.
So 10 to 15% shift from oil to renewable and non-conventional energy has already happened.
Right.
But it will take much more time, maybe another 1 or 2 decades, before we would see a larger conversion from conventional energy to renewable and non-conventional energies.
Okay.
As far as oil is concerned, currently oil price going by Brent is trading at around $88, $89 per barrel.
Right.
Our view has been that $80 per barrel was a support level, and from there it could move up.
Okay.
And we believe that it could move back towards the $100 per barrel level because of one major factor, that the dollar index is weak, which means that the dollar index is right now at around 102, 103 levels. So the dollar is cheapening up. So if dollar is cheapening up, then commodities quoted in US dollars like oil or gold and all that, their prices could gradually move up. So against a weak dollar, oil prices could move up.
Okay.
There are some forecasts which have put the oil price target at around 110 or so. But we don't think it could move towards that level. It could probably be moved towards the $100 per barrel level.
Okay.
And as far as alternate and conventional energy is concerned, it's an expensive thing to do a lot of research into non-conventional energy sources and development of that. It's extremely expensive.
Okay.
Therefore, generally, there is an incentive to do such research to develop alternate sources of energy.
Right.
Only if oil price goes beyond, say, $120 or $130 per barrel and remains there for a substantially long period of time.
Okay.
Yeah.
Sure. End of 22 saw interest still rising. Do you expect the rate to cool off this year, or they will stabilize at the current levels?
Interest rates movement would depend on two factors. Fundamentally, especially the long end of the curve, long-term rates. Say, for example, like the 10-year Government of India security yield. That is the Government of India going to borrow any additional amount for the rest of this financial year?
Right.
It is highly likely that the government could borrow maybe 1 lakh crores or 1.5 lakh crores. Some studies have put it at around 80,000 crores.
Okay.
So if it is 70 or 80,000 crores, it's not a very big amount. But if it crosses 1 lakh crores and goes to maybe 1.5 lakh crores or something like that, then it will put some pressure on the markets because there will be more supply coming into the markets. A second factor which would determine long-term interest rates is the borrowing program of the government for the next financial year, which we'll know from the budget. It's expected that the borrowing program for the next year could be to the tune of about 2 to 2.5 lakh crores or even 3 lakh crores. Because government needs to spend money on various schemes like the PLI. Government needs to expend money to promote private capex. All these things would entail a lot of monies to be spent on from government side. Government as a component of aggregate demand has to be visible and has to be substantial for it to have an impact on the aggregate demand in the economy. Therefore, we feel that these two factors would be very, very critical to determine the course of long-term interest rates. That's how much is the government going to borrow some extra money in this financial year. For the next financial year, are they going to borrow much higher amount than 1 or 2 lakh crores? Is it going to be around 3 or 4 lakh crores? These are some of the factors which would be critical for the interest rates. As far as short-term interest rates go, we feel that the short-term interest rates will continue to be under pressure and it will start moving up further.
Okay.
Say, for example, the liquidity, systemic liquidity is less than 1 lakh crores, whereas we had about 8.5 lakh crores in the interbank market as liquidity surplus for the last couple of years. Therefore, we feel that the liquidity condition itself would propel the rates a bit higher. Second factor is that the credit growth of the banking system has been to the tune of about 17 to 18%,
Okay.
whereas the deposit growth has been only 8 to 9%. Therefore, banks require a lot of money, and banks could come into the markets to raise funds or resources. That could also put further pressure on interest rates.
Okay.
So at the short end of the curve, short-term markets, interest rates could rise maybe by another 0.5% to 75 basis points. At the long end of the curve, it will be determined mainly by government borrowing program.
Okay.
That's our view on interest rates.
Okay. Okay. Gold has not seen any interest in 22 despite inflation. Do you see any difference in 2023 for gold?
As far as gold is concerned, there are two things that could help gold and gold prices. As I mentioned earlier also, it's highly likely that we may have recessionary conditions in all the major economies. There will be sluggishness in economic growth. Generally, at such times, the demand for gold goes up.
Okay.
So, in the coming 3 months or 6 months, you could see gold very well supported and it could move up.
Okay.
Currently at around 1930.
Okay.
So, you could very easily go to 2000 or even
Okay.
maybe higher than that. But the base would be, the support level would be somewhere around 1860 and 1830 levels.
Okay.
So, recessionary conditions could support gold prices. A second factor which I mentioned with reference to oil also is that the dollar index has come down all the way from 114 to now 102, 103 levels. Whenever dollar weakens, the prices of all those commodities which are quoted in US dollars would also go up. The prices would go up. That is mainly because those commodities are quoted in US dollars. The demand supply factors with reference to those commodities also do matter. But one major supportive factor is the depreciation of the dollar or a weaker dollar. Therefore, we expect gold to trade higher.
Okay. Okay. My last question to you, Dr. Joseph, would be, in your recent interview, you had indicated that US and China would be crucial from the economic perspective in this current year. Do you see any diversion in the RBI Fed approach to monetary policy? Also, do you expect China to attract investments?
Yeah. China and US and India are the three large engines of economic growth apart from Europe. So China, US, India, these are all major engines of economic growth. We already know that there is a very high probability of economic slowdown in the US. In China too, the last quarterly GDP growth was reported at 3.5%. Chinese economy is expected to grow at around maybe 5% for the whole year.
Okay.
We feel that the rate of economic growth could be something like 5 to 6% for China. And China also faces issues mainly on the real estate front. They have a lot of real estate delinquencies and also major firms which are facing liquidity problems. Therefore, the two engines, that's US and China, are facing lower rate of economic growth. So therefore, the third engine which could help the global growth is India.
Okay.
Indian economy is expected to grow at around 6 to 6.5%, and it is a much higher rate of economic growth compared to China or US or even Europe. Therefore, we could attract funds into India. But coming to the markets, there is one thing that we need to keep in mind is that our markets are quite expensive on a relative basis, and on the fundamental price earnings perspective, the local markets, domestic market is quite expensive.
Okay.
But there is another point which we need to keep in mind is that the rate of economic growth, the potential for higher growth and the potential for earnings growth is much higher relative to any other economy in India.
Right.
Therefore, those are supportive factors. And whereas if you look at the Chinese markets, the Chinese markets were sold off heavily, and the markets came down by about 45-50%. That has been it's a drastic fall in the markets on the exchange. So that makes those markets, especially the Chinese market, more attractive for an investor to go in because it's much cheaper to buy. Second factor is that there are a lot of analysts who believe that, we do believe that, we cannot write off China just like that right. Their growth is only 3.5 or 5%. China can just come back very fast because they recently lifted all the pandemic-related controls, right. And economic activity has picked up. And therefore, we feel that China could come back very fast,
Okay.
and the markets could also do well. But Chinese markets are looking quite inexpensive at this point of time. And if you go by some of the recent reports, in the last month or so, we have seen FII outflows from India to the tune of about maybe 1.5 billion or thereabout, whereas China has been attracting funds
Okay.
from overseas investors into the Chinese markets. So China looks good.
Okay.
Coming to the divergence in the approach of policy of Fed and the RBI,
Right.
we do not expect the divergence to happen immediately,
Okay.
because the conditions are not conducive for divergence at this point of time.
Okay.
It is mainly because of the fact that the rupee is weak. Rupee is at 81, 30, 40. It was at around 83. It just strengthened a little bit. We feel that if Fed keeps on, it is highly likely that Fed could hike the Fed funds rate by another 0.5%, maybe 0.25% each, maybe twice.
Okay.
Therefore, if that's the stance of Fed, because Fed has to bring down inflation from 5.5% to around 2%, which is the long-term inflation rate,
Right.
then they have to take policy action, and that would require the Reserve Bank of India also to hold the rates at the same level, or could even hike the rates.
Okay.
Because if you do not hike the base rate, the repo rate, that could adversely affect the dollar rupee exchange rate.
Okay.
Rupee could become quite weak or weaker still if we keep our interest rates still and we do not carry out any hike in the interest rate. So it's a restrictive factor.
Okay.
But the RBI could hike the rates by maybe another 0.25% or 0.5%.
Okay.
Similarly, the Fed could also hike. Once both the economies have achieved their inflation targets, currency levels, and all that to a certain extent, only after that, once we have normal conditions, there could be a divergence in the policy approach of Fed and the Reserve Bank of India.
Okay.
So it requires conditions, normal conditions, lower
Sure.
inflation and smooth economic conditions. So these things are prerequisites for the divergence to actually happen.
Okay. Thank you, Dr. Joseph. Thank you so
Thank
much
you
for
very
taking
much.
out time and interacting with us today.
Thank you very much.